Welcome back. In part one, we made a couple of pretty bold assumptions to be able to forecast possible returns the market might show us in the future. If you recollect, we looked at this picture and it gave us a bell-shaped distribution with some pretty strong assumptions. First of all, we assumed that returns are random. Then we assumed that returns are independent of each other, and then we also assumed that returns will deviate around some middle point. So are returns random? Does the future or the past have no influence of what happens today? There are a couple of interesting works, and to close into this topic, I thought I'd get the big guns out, and the big guns in this case Mr. Eugene Fama and Mr. Robert Shiller, and with an asterisk, Lars Peter Hansen, who all received the Nobel Prize in Economics in Stockholm in 2013 for the following topic. Mr. Fama did prove that stock markets, financial markets, are random. Mr. Shiller proved that they are not random, and Mr. Hansen got the Nobel Prize awarded for developing the tools to check on these two guys. So the Academy in Stockholm obviously has a good sense of humor of rewarding the Nobel Prize to two completely opposing views about the nature of markets. And we so far assumed that we work on a random basis. So that's the random walk hypothesis. And this is usually split into three parts of efficiency, of an efficient market. There's the assumption that there's weak efficiency, that the past is already perfectly priced into historical prices and price trends. Past price movements do not provide any information about future price movements. Okay? That necessary conclusion out of that is no excess returns can be achieved through technical analysis, or rather the creation of rule-based trading systems, algorithms, or that sort of kind of thing you all try to employ. We're all working with our set of rules. So all of that, if we have a weakly efficient market, is out of the window already. But it gets worse. In a medium strong efficient market, that's really the term they are using, in addition to market relevant publicity, publicly accessible information is already included in the price level. What does that mean? The market reacts immediately to ad hoc news and adjusts accordingly to the now fair price levels. What does that mean? Even if earnings pop in, the reaction time of the market is so fast that a positive or a negative surprise is maybe accessible for one or two guys who immediately print the button, and then the market is at the new fair price immediately. What does that conclude? Fundamental analysis offers actually no value or advantages at all, because the information is adopted in the market so fast that all your good analysis actually has no chance of giving you a leg up in a mediumly efficient market. And then the worst case scenario for the random walk, or for everybody who believes in that cleverness can give you a leg up in the market, is the strong efficient market, the strong efficiency hypothesis. Insider information in this scenario is already priced into the current price levels, however that would work. Adjust prices so fast that there's no possibility to outreact the market. And necessary conclusion, insider trading is a fiction, which is very, very interesting, because one of my defenses, if I would have ever been accused of insider trading in a court of law, would be to ask as a witness for the defense the Nobel Prize winner, Mr. Eugene Fama, who would explain to court that insider trading is obviously not possible, because he actually put out mathematical proofs that this is the case. Mr. Shiller obviously argued against that and proved that this is not the case. So both of them are absolutely correct in their methodology. However, both can't be right, or can they? So let's look at these different points. Now we start at the back with the strong efficiency, insider trading. Let's simply observe what we can see in the market. Do we see insider trading? Yes, of course. People are getting prosecuted for that all the time. Do we see front running as one of these things that would not work in an efficient market? Of course we see front running. In the past it was even legal a long time ago. Now it's highly illegal and you go to jail for that. Fraudulent IPOs. Yes, of course, we've seen that a lot. We've seen it in the new age economy when it came up, when suddenly weird companies who actually did not really have a business model were just collecting money and the market was so frothy that everybody bought it. Then pyramid schemes, Ponzi schemes. Yes, we all heard of Bernie Madoff and what that could do to the market. However, it still existed, right? Speculative bubbles, we're right in one of those again. At very strange levels, right in the tail end, or maybe not even the tail end of the Corona crisis. And then the sheer existence of supervisory authorities, the SEC, I think is the strongest evidence that the market can't be strongly efficient for the simple purpose Mr. Farmer would be 100% correct, and you couldn't prosecute anybody for anything ever again, because whatever they did with their front running or you name it, it would have already been in the market and there would be no chance to have an unfair disadvantage. So let's exclude that for the moment. Then we have a medium strong efficient market. What could we sum up in this? Growth versus value investing. You know, all these strategies which are based on fundamental research are in here, obviously. Smart beta strategies, risk parity strategies. Ray Dalio got famous with this. Market overreactions and volatility effects are all being observed in the market, and there are a lot of portfolio managers who outperform for long periods of time markets. This would also not be possible if the market would be strongly efficient or medium strong efficient. Now it's a question mark, okay? Let's look then at a weak efficient market. What does that entail? We already said it would not make sense to have momentum strategies in there, which are based, you have a look at the chart, you have a look at the volume that is trading. You wouldn't be able to employ serial correlation effects, the January effects, the weekend effects, the Christmas rally, etc., etc. They would all be out of the window. Having mentioned those, January effect, weekend effect, Christmas rally, it's very interesting. That is actually quite a nice indication that markets are very efficient, because the moment they're being observed and everybody talks about it, they tend to disappear. The football indicator, whichever leagues wins in the United States tells us whether we have a strong equity market or a weak equity market. So taking all these things into our let's say humble model shows us already that something with the assumption we employed in the standard model cannot be right, because all these different strategies, all these illegal methods, all these things going on in the market apparently does help some investors, the honest ones as well as the dishonest ones, to achieve additional performance. So they are not just trading like the market is trading. They have, over short periods of time, medium periods of time, and long periods of time, obviously outperformance against the market. And this would not fit with the assumptions that markets are purely random. If you have a purely random market, you could throw darts. You have heard of this famous example of the monkeys throwing darts at a wall where there are simply stock prices and that they will outperform every fund manager. If that would be the case, if the markets would be really random, you would observe this, and all these little examples I just did introduce would not make any sense, but they are observable in the market. So I think we are here on a dodgy leg when we started talking about the scenario that everything is completely random, that prices are independent, and that the past has no influence on the future. How could we reconcile that? Because data also shows that over really long periods of time, and let's not take 10 years, because Warren Buffett outperforms 10 years, he also outperforms 20 years. But over long periods of time, there is actually no advantage over a buy and hold strategy, where you would buy the Dow Jones. You would simply buy the S&P. And 30 or 40 years, we look at the performance, and we look at the performance of the discretionary managed fund. And they most likely, at least that's what the data shows for the past, would end up pretty much at the same performance. So that is a strong point for efficient markets that work randomly. How can we reconcile that? I've tried a little bit here. I said, okay, over a short time period, markets are not really efficient. That's the weak efficiency effect that works. You can work with momentum, you can work with serial correlation, with all the little strategies out of technical analysis that seem to work over a period of time, then they disappear. However, when they work, you can use them. Then if we go further out on the time scale, then markets are getting more and more efficient. So you have to put more work in. You have to put fundamental analysis into it. You have to deploy different strategies. You have to optimize your portfolios. You have to employ the toolkits that the financial markets are actually providing you. And in the long term, the strong, efficient market, well, I still believe that yes, the market is extremely efficient, and over a long period of time, probably profits made out of front running or insider trading will eventually be evened out, that you will end up with this performance buy and hold strategy versus a discretionary managed portfolio in the long run, not making too much of a difference. If you are interested in these topics, I can strongly recommend you the articles of Mr. Eugene Farmer. They are on the internet, especially his groundbreaking thesis, which also made his whole later career, where he goes into detail and not too complicated about the different states of efficiency, and he explains quite well why that could be the case. However, done what I've just did, gave you the little examples what might speak against it. It should be in the back of our minds to say, okay, if markets are not random at all, and maybe only over a very long time period, what is it then? How can we approach this topic? And there we move into another bunch of Nobel Prize winners in the sector of behavioral finance and complexity theory, causal interference by Daniel Kahneman. And which behavior represents actually an efficient market? That is the main question. If we assume markets are efficient, and Mr. Farmer said they are, and we have used in part one the bell curve and did calculations, forecasts, predictions out of this, what does mean an efficient market in this definition? I usually then have a live experiment with my students in search for the Homo economicus, because that is the best approach to tackle it all. Let's assume you have two investment alternatives. Investment alternative A pays you out $100 with a 100% probability, and investment alternative B pays you out $200 with an 80% probability. What do you choose? Well, we start with simple math again. We have 100% probability for $100, which is simply 100% times 100. So you have a safe payout of 100 on average. And investment alternative B pays you out 200, but only with an 80% probability. However, this 80% probability multiplied with $200 gives you an average return of 160. So all of the students, besides one really smart or two smart guys, come in and say, no, it's alternative B. Yes, of course, I have a probability weighted outcome and I'll choose that. And the smart guys go for one. Why? Because they've already thought about what I'm going to show you in a second. In reality, we don't know how many times can you invest into a specific scenario. If you can only do it once, yes, obviously everybody would choose alternative A. $100 straight in my pocket, fantastic. But it could be 2 times, it could be 100 times, it could be 20 times. So this is already, how do you behave? What's your decision? What is involved in this whole string? So you see already we're branching out in the possibilities we see in the market. Then what financial restrictions do exist? Do you have enough funding? Do you need the cash straight away? Or do you have to even borrow money and you can't provide the funds you need for these investments? Or you can provide it only for a time period which does not match your investment horizon. That also shifts your trading investment strategy in a direction where you actually don't know what is the most efficient investment. We're branching out. Suddenly we have a matrix of decision-making points which not the fastest computer in the world might be able to calculate. Then are all direct and indirect costs in your investment incorporated? Are they accounted for? Do you exactly know what is the unintended consequences of your investment decisions? So who defines this efficiency? Yeah? Where does it actually come from? And then we have to look at a marketplace and think what's actually happening in this marketplace. How do these prices for our desired assets actually come into being? And we shall do that with by introducing something out of complexity. We look at markets now as a complex system which can have very, very interesting consequences if you look at it. In green, obviously we have the market, and in this market we have competition, communication. We have different agents who are within the market, and then we have agents who are outside of this market. They all communicate with each other. The traders on the floor speak to each other. Fund managers speak to each other. They also speak to politicians or their wives, spouses at home. And all these communications have influence within their decision-making process. So these are the endogene factors on the inside, and they are obviously in competition with exogenous factors on the outside. And you see here one agent we all know who loves to Twitter a lot. That has massive impact on the markets. So this interaction between what we see now with our tunnel vision of the same guys we love to talk to and the external influences will reshape this whole situation. There will be feedback loops developing, and in these feedback loops, agents will adjust their decision-making process. Yeah? You have then suddenly a group which gets bigger and bigger on the example in the right, which is, for example, very bearish on a stock, and the smaller group on the left is very bullish on this stock. However, the large group of people is out-competing the small group of people. They want to sell at any price. We see suddenly volatility going up in this feedback loop. So this feedback loop is self-reinforcing, and then markets readjust again until they've eventually reached an equilibrium, which says the stock price is where it should be because it's not moving at all. Everybody, or in a tight range, everybody thinks, yeah, fine, we've agreed on the price. Until then, what happens? A black swan. By the way, I've noticed PowerPoint doesn't have an icon for small, so I had to take the rubber duck. So that happens. The feedback loop gets into overdrive. Agents adjusting their behavior, communicating with the outside, communicating with the inside, adjusting to the new situation till a new equilibrium is reached, and then the same process starts over again. We mean lather, rinse, repeat. So it's the fantastic, you've heard this example of the butterfly effect you can see here. Tiniest influences from the outside or from the inside can have huge consequences. The butterfly effect is usually that a butterfly flapping its wings in Tokyo could cause a hurricane in New York. And I think there's actually something to it. We can't still explain how volatility arises, where it comes from. There are some very interesting thoughts by Mr. Schiller in his latest books about narrative economics, how these things might arise, and I'm pretty sure sooner or later there will be Nobel Prizes for this topic, which fascinates me a lot. Where does volatility actually come from? But volatility in these phases comes clearly from this interaction and this complexity we have in this system. So if this system is so complex and can actually not be predicted, how on earth can we really work with a bell curve? And how can historic data actually prove that there is a bell curve? That returns are distributed in a very specific way. So who is right in this? Is it a random market with no memory and no consequences? Or is it a highly complex market where tiny decisions can have huge consequences? Fortunately, there is an easy mathematical way to actually check on markets to get an idea what might be right, because we put in assumptions into a model and say, okay, how should a random market look like? And then we look at the real markets we can observe and measure this with a specific metrics, which I'm going to in the next part, to find out what the state of the market really is, and is there a possibility of these two models we've just seen, random walk on one side, complexity and non-random markets on the other side, can we reconcile that, and can we actually draw some conclusions out of this which might help us in our trading? So we've reached the end of part 2, and in the next part, as I already indicated, we will have a look how can complex systems, if they are indeed complex, be predicted. Then if that is the case, is everything alpha? Is it just skill what works in the market? Or does beta, the random market, the noise in the market, still has a role to play? Stay tuned and click on the next video if you're interested in the conclusion.